Hello, everyone. It's Thursday, March 26th. I'm Charles Brown, Portfolio Manager with CB3 Financial. This is your weekly podcast where we'll be covering the war in Iran, the markets being jittery, what's going to happen with earnings next quarter, and all sorts of items you need to hear. Stay with us. It's been a rough almost 4 weeks. At least after Friday, it'll be 4 full weeks. And it's not a fun time to be investing, and we all know that. We've been through this. Many of you have been with me over 20 years. We've been here before. I've been at my trading desk for 34 years through every cycle. We're going to get through this just like we got through all the rest of them. So what's driving everything, as you well know, is the war in Iran and therefore crude oil prices and therefore the Strait of Hormuz and who is going to control that. Iran is saying the only way they're going to sign a peace deal is if they control the Strait. I don't think Donald Trump's going to let that happen. So the U.S. sent Iran a 15-point peace plan via Pakistan. Who knows why it went through via Pakistan, but it did. Iran rejected it publicly, but they made a 5-point counteroffer. Well, at least that's a negotiation. It's not a dead end. So the big number, of course, is crude oil. So it's back below $100. For a while, it was in the 80s. Today, I think it finished up about 91. And that's not a bad number. We want to see it stay well below 100. I would argue that it's almost going to return to a risk on. That means good for equities. If the crude oil price in the front month, which is May right now, can stay below 90. If it gets down to the mid 80s or the low 80s, I think you're going to start to see capital pour back in the markets in a big way. So again, oil needs to stay definitely below 100. And if it stays below 90 and can somehow get consistent between 80, 85, that is healthy for the markets. So let's move away from the war and talk about PMI, which is the Purchasing Managers Index. That's a very important inflation gauge. And that was actually a beat. It was less than it was supposed to be. Remember, when you're looking at inflation, you want low numbers like golf. Everything else, you want high numbers like football and baseball. But for inflation, you definitely want low. And it's the lowest since April of last year. So that's a good thing. It's almost a year-old datum because April's here next week. So growth is slowing, all right? Prices are rising, but both of them are moving really slowly. Still, that comes out being stagflation, all right? That's what happens when growth slows, but prices are rising. So people get squeezed both ways. If growth is not occurring, that means growth in salaries is not happening and our homes aren't appreciating as much, but prices are rising. So that's a double whammy, all right? And it's not a theory, because now it's actually in the numbers. But again, this is just at the beginning stages. I think that this could get turned around big time if we can get this war situation settled in the Middle East. The issue here is that President Trump and many of us, frankly, that are portfolio managers and dealing with the financial markets, looking out for your best interest, do not want to see Iran have a nuclear weapon and have no capacity for it. And frankly, I don't think they're trustworthy to safely guide ships through the Strait of Hormuz. They can go out there and put mines and blow up ships anytime that they want. And I think they've lost the privilege to govern that. So markets like stability, markets like predictability. And that is what President Trump's trying to accomplish here. De-arm will help you reconstruct your country. You're not going to control the strait, and you got to put a leader in there that's going to be able to be in contact with us. We're not going to expect them to be a democracy. That failed in Iraq, let's face it. But that's what we need to see for the markets to settle down the jittery nature. I can tell you, as far as the options trading signals that we're seeing, we haven't made an options trade, and you know that I trade on the speculative side and you guys trade on the hedging side. That's what I do for your portfolios and for my own accounts, right? But it keeps me aware of what's going on in the options market, which at this point is bigger than the stock market. The last year or so, there have been more notional dollars traded in the options market than the stock market. So I'm involved in that. And I can just see the risk and uncertainty levels for the last 2 weeks make it literally untradeable, which tells me this war impact is even greater on the markets than the actual volatility of the stocks and indices are showing. So that's an important point. The S&P today up about 0.5%, down 5.5% from the high. The Russell's down about 8% from the high. The Dow is down about 8% from the high. When it gets to down 10%, that's officially, if you will, a correction. And then it takes another 10 points to get down to minus 20 below the lifetime high. And that goes into bear market territory. Not necessarily a secular bear market, just a cyclical. And we've had quite a few of those since the last secular bull market began in April, specifically April 10th, 2013. So we're now really about 13 years beyond that. These secular bull markets last from 20 to 25 years. If you watch my show, you've seen this slide many, many times. All right. So I think we're about half to maybe 3/5 of the way through this secular bull market cycle. And I don't think this war skirmish is going to dampen the markets in any kind of long-term fashion. So our options hedging is working. It's keeping CG, GI, and DS to the point where they're making money on the upside, and on the downside, they're losing less than the S&P. At least that's the way it's been for the last 2.5, 3 weeks. So the options hedging is basically just cushioning the ride. We may not make as much as we would make if we were unhedged, but it certainly feels better to be down 3% than it does 6.5 or 7% when the indices are down that far. So today we have jobless claims at 8:30. So by the time you hear this, that probably has already come out. And then Michigan consumer sentiment is this Friday. So I want to remind you guys that a week from today, that's April 2nd, will be the next CB3 Live. I'm actually traveling on the date when I would normally do the show. That's Thursday, April 9th. So Thursday, April 2nd, a week from today, if you're hearing this the day I published it, will be the next CB3 Live. I can already tell you the name of the episode is The War Zone. All right. And I don't expect this to be solved by the time of the show. And if it is, I'll be glad to rename the show. But I want you guys to understand the implications of that, what's happening in the equity markets as people hedge and protect themselves, just like we're doing on your behalf. And then we'll have an outlook of what the earnings for the first quarter should look like. So once we get to April 1st, earnings start to be released for the previous quarter, which is the one we're in at this moment with the very tail end of the first quarter. The earnings reports are always looking back a full quarter. So that will have an influence on the market. The war will continue to have an influence. And in many ways, after being here at this trade desk for 34 years, it's just business as usual. So don't be concerned. If you have concerns, send me a text, send me an email, cb3@cb3.com. You know my phone number, 312-513-7486 in Chicago. You guys have a great rest of the week and early part of next week, and I will see you all Thursday night, April 2nd, for the next episode of CB3 Live.